Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the March investment edition of the Wealthy Behavior Podcast, where I talk to Heritage Financial's Chief Investment Officer, Bob Weisse, about what's going on in the investment universe that we think you need to know right now. Bob, how's it going?
Going well. Yesterday was a bit of a roller coaster of a day, but overall it's going well. It's been a good year.
So we're recording this on Wednesday, March 5th. So you're referring to Tuesday. And, sometimes it's hard to figure out what we want to prioritize in talking about, but sometimes it's easier. And lately, I think we've been getting a lot of questions about this environment, the increased volatility, the policy uncertainty, and should we do stuff, quote unquote, stuff about it, either on the client's end or are we managing things differently on our end for them? So let's start there, maybe set the table. What has been going on and what has it done to market and asset class returns?
Yeah, so there has been a tick up on our end from client questions and concerns, and so maybe just to start, I'll first just go through index returns, just what markets have done. Let's start with the facts. So year to date, the MSCI USA index, so US total market, is down 44 basis points. So US large cap stocks negative about 0.4%. If you look overseas, developed international stocks, MSCI World ex USA is up 8.3%. So an 8% gain for foreign developed markets. And then MSCI emerging markets are up 2.29% year to date. So emerging markets are up about 2. And then investment grade fixed income, the Bloomberg US aggregate, is up 2.98%. So approximately 3% gain in bonds. So most portfolios have the majority of their assets are in global stocks and bonds. So really the sum of those four indices I just read off, and only one of them is negative, US market, and just barely by 0.4. The other are positive to a pretty healthy degree. And then real estate is up, like REITs, publicly traded REITs are up 5.2. Most clients have a REIT allocation. And private credit's up as well, which many clients have exposure to. So if I'm talking to a client who's concerned about the headlines and markets, if you just take a time out, overall, it's been a pretty good year. Wrapping up equities overall, the MSCI All Country World Index is up 1.89%, so almost 2% for global stocks. And I mentioned bonds up about 3. So we're doing fine. When we look at the themes, we've been really hammering home with clients, talking about getting the bond allocation to the right amount and maybe even overweighting a little bit. That's helped. And we've talked a lot about global diversification. I know, Sammy, you had Jeffrey Kleintop from Schwab on a couple weeks ago, and he did a great job. So we've been speaking to clients about globally diversifying and for, it seems like, many years. And I think last podcast I might have gone off a bit on a rant about I'm tired of people not wanting foreign exposure. Well, it's finally paying off. So it's nice to see. Now, those are the numbers. So what's been driving markets? Why is the US down and the other markets are up? There's a few things. One, I'd say it's the way we entered the year. So valuations in the US were high, top decile historically, even close to the 90s tech bubble level. And when you have high valuations, you can think of valuations as sentiment. It's a package, it's the price, it's how people feel about the future. And if you have high expectations and you're expecting good things and you don't see much in the form of risks, that's when you should have high valuations. And with markets, saying that Lizanne Saunders at Schwab frequently says it's not good or bad, it's better or worse. It's the price was high, valuations were high in the US because people were thinking things were going to be great. And if they just get a hair worse, then the price goes down. And when you're up that high, that there's more room on the downside. And that's what we've seen with valuations coming in, especially in the concentrated names. Big tech like NVIDIA is down quite a bit. So that's one, valuation starting high. And then two, we have seen some data come in that's been a little concerning. The Atlanta Fed has a GDP tracker. It's called GDP Now and Nowcast, where they're looking at what they think GDP will be for the first quarter. And it's been a pretty good guide over the last few years, like better than most um, economic forecasts. And it's actually shown economic growth higher than average for the most part, where it's like, oh, wow, this GDP now is really saying things are good while everyone else is calling for a recession. And GDP now turned out to be right. Well, it just dropped quite a bit, and it's down close to -3% for Q1 right now. So that's one concerning piece of data on the economic growth side, that GDP now is negative. And then on the inflation side,
Hey,
uh,
Bob, real quick, what do they base their analysis on? How do they make those determinations? Like what are the important variables when they're putting that together?
so it's not a forecast as much as they are actually trying to calculate GDP in real
Okay.
time. And if you go through the GDP formula at the end of it, it's net exports. And what it looks like is driving it lower is people or companies front-running tariffs. So the trade deficit spiked, I think it's for the month of January, where we imported a lot more than we exported, and that goes against GDP. So I think it's companies anticipating tariffs, say, if I'm manufacturing, I need steel, and I think I might have to pay a tariff on steel starting next month. I'm going to over import now, over order to get it before the tariffs come on. So I think it is tied to tariff concerns. And is it more of a temporary phenomenon or real? You could argue it's temporary. So there's a deeper conversation there, but just the headline number alone, I think many people react based on seeing the negative growth number. There were other components of it too that weren't as severe, but were still slightly concerning. So bottom line, seeing GDP now is concerning on the growth front. And then with inflation, CPI has been ticking up. So the Fed's target is 2%. We get CPI readings monthly. Last month, it came in at 0.5% for the month, and the month prior was 0.4% for the month. So when you're trying to hit 2% over 12 months, having a zero point 0.4 and then a zero point 0.5, and these numbers, we're going to be stuck with them for the next 10 months when you're looking at trailing 12-month CPI. So seeing inflation being elevated, and this is coming from some 0.1s and 0.2s, so really an increase in inflation and it being above target paired with slowing growth is a bad mix. So there's real data reasons why investors could be a little more concerned. And then there's politics. I think it's fair to say, without getting too political, that uncertainty is up. And with higher uncertainty, that typically leads to lower multiples. People are less willing to take risk. There's a broader range of outcomes, and prices come down. So talked a lot here, but I think that about summarizes what's played out in the U.S. And meanwhile, foreign markets, this is a U.S. centric story that I'm talking about, and foreign markets are doing well, and bonds have been doing well as investors are looking for more safe havens in their portfolio, the flight to quality in bonds.
So, Bob, digging into that a bit further, what would you attribute the move in yields to or bond pricing?
Yeah, I think it goes more to the growth scare,
Okay.
where typically markets are risk on, risk off. And like asset allocators like us, like I said, the main tools we have are stocks and bonds. You can do some alternatives, but most people, it's really stocks or bonds. And if you want to take your foot off the gas a little bit, the natural, by reducing stocks, the natural recipient of that is fixed income. So if people are concerned about growth, they buy bonds. Demand for bonds equals price up, yield down.
How concerned should people be about U.S. stocks?
Valuations are still high. We've seen a little sell-off, but it's not like they're back to average. So it's still a good time to be globally diversified and have fixed income in your portfolio. I wouldn't say like so concerned you shouldn't own any stocks, but I would not be happy sitting there with 80, 90% of your money in US stocks. You should be diversified right now. Valuations are high. We think there are better opportunities elsewhere.
So you've fielded questions. I've fielded questions. The team has fielded questions from people asking, are we going to make any changes or adjustments based on, I think what's driving their questions is more the uncertainty, not the Atlanta Fed, not the CPI, not the valuations, right? The stuff that they're seeing in the news. But regardless, I guess the answer is the same, or can be the same, regardless of what's driving the question. How are you answering people who are wondering if they should be making changes because there's just a lot going on and we don't know what's going to happen day to day?
Yeah, so we did make some changes within the last 2 months, and it was not politically driven. It was, like you said, more valuation driven. But the people who are asking those questions, our changes do align with, I think, what they'd like to see. I would call it a little more coincidental that they want to see us getting defensive for politics, and we got defensive more based on valuations. But nonetheless, we have reduced risk, we have reduced equity exposure, we have increased treasury allocation, our allocation of treasuries, and we're globally diversified within equities, and that's playing off. And I think that is the positioning, the type of action that they would like to see. There are some clients. I had a call yesterday with someone who was saying, I think I might just want to go all to cash, just put it all to cash. And I'm sure you've had these conversations, whether it's recently or over the course of your career. And one of the things that we like to bring up is to go from invested in stocks, whatever your number in stocks is, let's say you're 60% in stocks, and to go from 60 in stocks, some people might say, oh, I just want to go to 50, but like in this case, the person want to go to zero. So I want to go from 60 to zero. For that to work for you, if you first start with the assumption that 60 is where you should be in a neutral environment, call it your long-term average, like 60 is where you want to be, but just right now, because you have some concerns that are tied to the White House in this case, you want to go to zero. For that to work, you need to get back to 60 at some point. I think we both agree that staying at zero indefinitely is going to lose. Like, cash will underperform stocks over decades. So you need to get back into stocks at a lower level. And that really should only happen if you're willing to get back into stocks when the outlook's even worse. So what would cause stocks to go down from here? It'd be a gloomier picture. It'd be more things to be concerned about. So if you're calling out because you're worried and you want to act on it, that's probably not the type of person who, when there's even more reasons to be worried, is then going to say, okay, now I want to go in. No, more what this type of person wants to do is, if you ask, when will I go back in? They're going to get back into stocks when the coast is clear, when there's no concerns, when they're not worried anymore. And guess what? Stock prices will most likely be higher when you don't have things to worry about. So that's just really a recipe for failure that many people do when they're left to their own. Oh, I'm scared of stocks. I'm going to get out, go to cash, and I'll get back in when it's better. That's really the definition of selling low and buying high. So we really try and prevent people from doing that.
So there's two things going on there. One is I think you're not a fan of drastic moves like that, right? All
Yes.
in either direction. But we do make asset allocation changes. And you did talk about the fact that we entered this year, a little bit more defensively positioned if your starting point is a US stock portfolio. So if you do want to have a process, on your own as a do-it-yourself investor, let's say, what would you do to make your asset allocation shift decisions? And how would you size them so that you're not being drastic, but maybe directionally doing the right thing and not gambling on the fact that you're just going to be 100% correct?
Yeah, you're right. So one, if you are making asset allocation decisions, we are a fan of making modest decisions, moving a few percent, not 10, 20, 50% at a time from asset classes. And the reason for that is it's very difficult to do correctly time and time again. We've studied it, not looking at ourselves, but looking at like Morningstar has a category, tactical funds, tactical asset allocation funds. And it's basically a group of funds that'll pick broad indices and just market time. And their track record collectively is pretty terrible. I think I had a hard time finding any of them that would do better than just like a buy and hold 50-50 stock bond portfolio. So you just look at it, and there really aren't people who continuously or regularly are able to get in and out of markets. Can you look at valuations and use that and lean a little bit into asset classes that are more favorably? We think doing it moderately is okay. But overall, markets do a good job at delivering returns for people over time. If you're a good, patient, long-term investor, And by getting in and out, you're putting that at risk. So that's just kind of one framework. But then the second thing that I would look at is the valuations, and then I'd pair that with sentiment and like the Warren Buffett quote, be greedy when others are fearful and fearful when others are greedy. Right now we have, I'd say it's a mixed environment where valuations in the US are high, but I'd say it's a little more fear than greed right now. Earlier in the year, more greed than fear, but this is not what top of a market looks like when people are panicking, and yet prices are still pretty high. So typically going against the what the gut instinct is telling you to do is the right thing. And sentiment, we're not in an era of irrational exuberance right now, I would say, but valuations are a little stretched. So it's a mixed picture. So that's something else I've talked to a client who wanted to get more defensive about. And um, just as far as don't do anything drastic right now, because a way to think about sentiment is when people are fearful, they're positioned in many cases accordingly, and they likely have cash to put into the markets. When they're not fearful, they're all in, and there's no backstop. It's like shock absorbers on a car. That it's a support there. If you have extra cash collectively by people being defensive, then in a downturn, there's money coming in. If there is no cash on the sidelines because investors are all in and they've got nothing to worry about, then you're more at risk. And I'd say we've probably transitioned a little bit from people being more closer to exuberant and all in on risk to now people are a little more fearful and more defensive.
And Bob, there's some noise in the public markets, right? Because of the, second by second pricing mechanism. And what are you hearing from our private investment managers? What are they seeing concerns in this environment? Are they deploying capital the way that they like? Are they not kind of tracking to the returns that we would expect over the long run?
Private markets are definitely different. They are excited, I'd say collectively, about the new administration, less regulations, and are expecting more deal activity. What we've seen in private markets like private equity and private real estate the last few years has been a slowdown in deals, whether it's companies being taken private or companies going IPO. So just overall lower turnover, and private investors are call it deal people, where they like to be buying and selling assets, and they're expecting and hoping for a pickup in activity in 2025. So it's been a slower market for them. It's been harder for them to raise capital. So they're more, I'd say, optimistic about the future. But I haven't really heard anything about the day to day. They're not in it minute by minute like public markets, have to navigate. That's, I think, one of their advantages.
Sure. No, I understand that. So what are you and the team focused on? You talked about a lot of data points, valuations, uncertainty in this environment. What are you all watching in terms of portfolio management metrics or, things in the economy to give you a little bit of a sense of where things are going?
We do take it back to Fed policy. We think that is a key driver and what they look at. So you heard me talk about CPI and economic growth. So paying attention to that. But overall, I think we are well positioned. We've made moves over the last few years directionally, and we're happy with our positioning. We are looking at private markets. That's going to be picking up in the next few months, looking at solutions in the lower middle market, private equity. We're doing more with direct indexing and leveraged direct indexing, the long short, separately managed accounts. So more on the tax front. So there's a lot going on, but different solutions for different situations.
And Fed rate cut expectations have gone up this year, right? Recently?
Recently, as of yesterday, I believe. I think now I think we entered the week at about 50-50 for June, and now it's north of that, maybe around 75%. So it went up yesterday to, I think, more likely than not that there'll be a rate cut in June, but that's still a ways away.
And what would be driving that, Bob? Is it the potential economic slowdown, CPI creeping up, labor market weakness, all
Yeah.
of the above? Like what do you think is is behind the increase in expectations?
All of the above, but I think they would need to see an improvement in CPI. We can't have 0.4, 0.5 monthly readings and get a rate cut. I would not expect that. So there's a lot of data to come out between now and then, but they're really looking at the labor market and inflation. And if inflation looks under control and the labor market's slowing, I think we'd see a cut. Otherwise, it's stay the course.
Okay. All right. Well, thank you, Bob. I really appreciate your insight as always. And I know that our listeners do. There's a lot going on, and you help simplify and clarify, and I think keep people patient and grounded toward their long-term goals. So thank you.
Thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.